We are coming up, Brian Wang. We are going to have an economy that well, some people are expecting. Kathy Wood's expecting it. Other people, Secretary Lutnick is expecting it. But I think the vast majority of the population of the United States and the world is not expecting what we're going to get hit with next week.
Mhm.
So you and I have been talking about this since yesterday. We've gotten a lot of notes down, and
Mm.
I think we've accumulated in a way I don't see anybody else accumulating it this way, even Kathy or Lutnick. Um, all of the impacts, all the things, all the pieces that are going to come into play in the first quarter and then beyond. So I know that you have analyzed it, put it together, and put it into a beautiful spreadsheet. So I will turn it over to you.
Okay, let me get over to that. Uh, okay, so basically, the case is that Lutnick and Besant have talked about 6% GDP growth. So we're already at 4.2%, and the general consensus is that we do not sustain 4%, that we drop back down to 2%. That the case for a sustainable 6%, and one, sustainable 6%, 4% would be huge, and sustainable 6% would just be massively world changing to the level of the post-war boom or the late 90s tech boom, that kind of stuff, where the economy just like really humming at 6%. For people who didn't live through that, 6% GDP growth, everything feels different. Okay, like the world, the economy is feeling really, really good. Like it transforms the country and the world. Like China's 6%, 8% growth is also like a radical kind of shift. So the core of this is that all those deals in the Middle East and other countries, for the tariffs, where they have to invest a lot of money into the United States, they're talking about investing $3 trillion per year in 25, 26, maybe 27, as you add up all these deals and how they're kind of like playing out. And also it is the hyperscalers, the big tech companies, Microsoft, Amazon, Google, Meta, all those companies spending the hundreds of billions of dollars and now getting more deals from sovereign wealth funds, SoftBank, et cetera, to continue to back that up. So not just their money, but amplified with private equity and those kind of things.
So that's like number one. But let me go back and flesh out in my mind how I see the 6% increases.
Sure.
So the 1990s, we were at 5% GDP increase, not
Yeah.
6.
Right.
5% would be great. We saw what that did to the economy in the 90s, and we also had the federal government cutting back payroll and cutting back expenses. So we actually got into a surplus situation during the 90s. And this is the natural consequence of being at 5% or 6% growth, is that now you have additional money coming into Treasury. If you've also got the government cutting at the same time, then that reduces the overall expenses, which reduces the deficit or potentially gets you into surplus. So I didn't go back and look at the numbers for the 50s, Brian, but I know that in the post-war era, we had been, obviously the deficit during the war was huge. So I know we also paid down a deficit during the late 40s and early 50s as well. I just didn't look at what the GDP growth was during that time. Kathy
Yeah, the GDP
Wood,
growth I don't think was
oh,
6%.
it was
If it
not at
was, it was very
6%.
short. It was not sustained. No.
Right. Kathy Wood goes all the way back to the turn of the 19th into the 20th century and says that all of that transformational industry that we had, the steel industry growing, the oil industry growing, the automotive industry, the telephone industry, the electric business, all that stuff was happening at the same time, almost like we're seeing now with all the things that are changing. And again, I think she said this was maybe more of a way to make the comparison is more about that era because of having a confluence of all those industrial changes.
There was, in terms of the scale of what we're talking about, in terms of the investment, why does, $3 trillion investment per year matter? Is that is 3 times the investment, or even 4 times the investment of the Obama infrastructure bill that he had. I think it was like $800 billion for that. And this would be, 4 times that for every year for multiple years. And the COVID stimulus was about $4 or $5 trillion. But this would be stimulus that would be for the infrastructure of the future.
Right.
So not just for, I'm just making highways and doing things, pulling forward some activity I was going to do anyway. I was going to fix the highways and roads, and now I'm doing it this year instead of over multiple years. This is infrastructure for the future. People can debate about, how much productivity you get. We have, I think the cases that we've seen is that the AI productivity growth is real. So you're having infrastructure for the future that is good infrastructure spend that will have returns that will build the economy. And then just from this first AI infrastructure build portion and early benefits, we're going to see this 6% growth. So this is kind of like the preview of something that could be even better if the full AI story starts to unfold, which is what Kathy Wood is talking about.
Right. And so yeah, so if you take a look at the as you were just pointing out, this 3 trillion a year, people forget that multiple pharmaceutical companies have said that they're going to reshore. We have the strategic reshoring of our steel and copper business. We have the strategic reshoring of the rare earth mining and refining, and actually production of magnets. All of that coming, and that's just the surface. There's a whole bunch of companies that are bringing back manufacturing to the United States that would be much smaller. They might only be $100 million companies or $50 million companies. And then there's some that are going to be $1 million companies that are seeing the opportunity to start manufacturing in the US.
And the other thing would be that if it's over multiple years, the difference between 2% GDP growth and 6% GDP growth is a 20% difference on the GDP over that time.
Right.
So, and that would be 20% per capita GDP difference.
Right.
So difference of 20% GDP per capita is like, within the United States, looking at the states would be something like California versus Mississippi, right? Going from the high end richest state to the poor state is like we're going from poor state to rich state, or in terms of like Europe, perhaps between I think Germany and Italy or something like that. It's like, Germany's richer, more industrial, and then Italy. So these 20% GDP difference, you would notice. It would be, it's not like, oh, it's 6.4%, it feels better. It's like these are differences which are, real and non-trivial. That would be, if you sustain that multiple years, 4 years, 4 years, 4 years, 10 years, then it's like you're going between over 10 years, a double versus not. It's like Mexico versus Canada or something like that.
All right, let's make it more practical. Okay. Yeah. When you have these kind of productivity growths, one of the things that happens in every industry, this happens. So we're all in the Tesla game. Okay. What have we seen as Elon has increased productivity on the vehicles? What have we seen as he's increased the productivity on the, the megapacks? Is that the price comes down. The more you produce, the more the price comes down. So, I sit here and look at my 84-inch television. 5 years ago, I would have been super proud of an 84-inch television. I would like in the neighborhood, everybody come to my house for football. But last year when I bought it, it was under $1,000. So this is what productivity does. It reduces the cost of goods. The opposite and the flip side is it increases real wages. So you've got your costs coming down at home, but your real wages are going up because you got more overtime and the actual hourly wage goes up. So you have more money to spend and it costs you less to go out and get the products and services that you need and want, not just the ones you need.
Okay. So we agree, totally transformative. You'll feel it. It's a big difference. So now we're going to dive into how much has happened and then how much will happen so far. So the $3 trillion per year, this year and next year, that is indeed happening.
Right.
It already happened. It will continue to happen. The deals are in. The investments are being made. It's happening. 10 out of 10. So then 2025 factory builds, 2026 jobs. The lag is real. AI confirmed that. There's the semiconductor fabs, Arizona, Texas, all these things happening, other new factories. That is 9 out of 10 because we're still waiting for some more hiring and for more build out. So those are happening. Q3 GDP was already 4.2%, but then, and now we're talking about this 6% thing. So the Atlanta Fed, street consensus, every bank has an upside AI scenario around 4.5%. So 6% is possible in a quarter, but it's not annual averages yet. But the word from Bessent and us they expect Q1, Q2, Q3 to get there. So we see how close we get as we roll into that. So that's 7 out of 10, haven't happened yet. There's indications. We still have indications, but not fully there. But far more real than at some 2-3% where we're seeing those numbers. Right. Go ahead.
Yeah. And while the 6% is aspirational, even if we're at 4%, even if we're at 3%, we were only at 2% during the entire Obama administration. And most people don't look back on the Obama administration as horrible. So if we're going at 3% or 4%, that's much better than that period. If we get to 5 or 6%, it's crazy time.
That's right. So we have real income gains, wealth effects, confidence spreading. So we have the no tax on tip, all on deductibility. So those big beautiful bill type changes, looking like disposable incomes increasing at 2 to 3%. So there is already some of these income wealth effects that we're seeing, that the numbers are showing that this traction is real. So then the question is, can we sustain as the GDP stuff happens?
Okay, so we need to look at that really specifically, and I've talked about it a couple of times on my show before, but I think it bears repeating. Almost nobody is paying attention to the fact that in the first quarter, the refunds that individuals and businesses will be getting back will be dramatically higher than they're expected. 4 groups. Number 1 will be those who get tips. Number 2 will be those who get overtime. Number 3 will be Social Security recipients who will get a big change in their. We're estimating for my house $2,000 more in a refund than we would have gotten otherwise. And then corporations, all of those will be bigger refunds because of the big beautiful bill, but then they'll be able to reset their estimated taxes. So now their monthly going forward becomes lower as a result. So this is going to be a double hit to the economy in the first quarter. It's not maybe, it's going to happen.
Right. So higher GDP, tariffs, and treasury revenue. So tariffs are already bringing in several $100 billion. It's 2 to 3 times higher than last year's level, 2024 levels, and investments targeted, a deficit below 6% of GDP, which I think was like 8-9% of GDP. So that basically means instead of like 1.5, 1.8 trillion dollars or $2 trillion, it's down at the 1.2 trillion dollar level. So stepping down, going in the right direction, not to zero yet, but certainly by 2027, trends continue, you'd be under $1 trillion. If you have your 6% growth, you'd expect $500 billion to $1 trillion less. So then over 2 years, not inconceivable, if you didn't increase spending otherwise, which you may do it, you could get to a balanced budget with this kind of growth.
Yeah, and you've got ratchet effects, all kinds of ratchet effects taking place. So your income increases, therefore you have to pay more taxes. Your corporate incomes increase. We've seen what corporate incomes have done this year. So you end up getting more taxes from that. You got the tariff, of course, you talked about that. Then all of this, as you get the deficit down, then the folks that play the bond market are going, oh, you're getting the deficit down. We don't have to charge as much. And if your inflation is going down, we don't have to have a higher number on your treasury bills. And so as those come down, then the Fed isn't spending as much on interest. And so that's another reduction in the overall Fed budget.
Right. So that goes to this lower rates, lower deficit virtuous cycle, which AI is saying, yeah, check still 6 out of 10. So that in theory should happen. We still have to see it happen. Fed funds rates now at that 3.75 or 4%, and then rates can stay lower for longer than the consensus thinks if this plays out as you just described.
Right.
Massive February, March 2026 refund shock, which you just mentioned, that this is a huge deal. Yeah. So that could be, $100 billion extra funds in Q1, which again would boost the quarter and could have lingering effects into the next quarter. So the base case without meaningful AI productivity is 3.8 to 4.5% real GDP growth, which is sustainable at that level, double the growth that most analyst industry researchers are projecting. So at the high end of Wall Street, and would it feel like escape velocity? Then if we layer in the AI boom, phase 1, phase 2, where hyperscalers, meaning the Googles, the Meta, Microsoft, et cetera, will have 2 to 3 times GPU equivalents. The enterprise adoption is getting more real. There's a bunch of numbers tracking that. And if we get to next level AI in 2026, which many insiders are projecting that in 2026 we can get your Grok 5, and then everyone else will also have B300 based models, which Gavin Baker, head of a multi-billion-dollar fund, who has insider views on that, thinks that's going to happen. So then, if we're already seeing this traction, these returns, OpenAI may be making $20 billion. That next year, with even better AI, all the players in the AI field and also the companies using it, like Amazon, etc., would see the returns happen and more growth, $50 billion per company for the leading companies, something like that, which would starting to offset. It would be matching what we need to see the growth, but it would sustain the spending that we were talking about in the first part.
Right.
The trillions of dollars of investment would be paying off, which is, if the AI boom happens, then it's sustainable, and also that productivity of workers getting 2 times, 3 times, 5 times more productive would start filtering in the grand economics of total factor productivity.
And then later in the year, the humanoids and the 4-wheel robots will start having an impact. It probably won't have a huge impact on productivity in 2026, but by 2027, you could be seeing robotaxis and humanoid robots having a big impact. I also wanted to touch on this. Maybe you've got it later in the slideshow, but people are talking about the job losses. They have to keep in mind that if we do have job losses, we will have wealth gain. If we have wealth gain, then people will go out and buy stuff and trips and experiences and restaurant food, and that will increase the employment. So I don't have any worries about employment next year. In fact, if anything, it's the reverse. I'm a little nervous that we could get into a shortage.
Right. So there are the potentials for 3 or 4 real problems in 2026. I think in your thing you called out is there's house affordability, there's healthcare costs, and there's energy and natural gas prices, and a commercial real estate maturity wall and regional bank stresses. So do you want to discuss those in more detail, or do you want me to
100%. I think it's really important. I think the economy will be booming, and that'll be great. And it probably means that, the Republicans that'll happen soon enough that the Republicans will win in the fall. But there's going to be 3 things that people can still gripe about. Okay. And these are going to be, wallet issues. And then there's going to be a corporate issue or a banking issue, as you just pointed out. So the electricity and gas prices going into the winter are high. And I don't think they're going to come down unless the president steps in. He's going to have to do something. He's going to have to jawbone it, or he's going to have to get on the phone and talk to his buddies, or he's going to have to come up with that $2,000 stimulus check to offset it. But otherwise, people are going to get those utility bills. We've seen it before. We've seen how X explodes, with people talking about, oh my gosh, I just got my gas bill for December and it's, 8,400. No, I'm kidding. But so that's gonna be an issue. Housing affordability, yes, it's coming down right now. In fact, rents are actually decreasing. But I don't think that holds up because they're not building anymore right now. So we could be going as the interest rates come down. We've seen every time that the interest rates come down, all of a sudden the houses get sold. And that's what we saw just this week in the reports that came out. The houses are being pulled off the market because people are going, oh no, I'm going to wait till the spring when the mortgage rates are down. Then I'll put my house back on the market. So supply and demand right now is moving back towards undersupply and over demand. And then what was the third one? I forgot already.
Healthcare costs.
Oh, healthcare. So the president's already addressing this. He's got to address it. We're going to have these increases in Obamacare. He's talking about the potential for doing something where we would give the money would go back and the consumer would spend it directly with hospitals instead of going through insurance companies. That sounds like a great idea, but it also isn't something that's going to happen in a weekend. If they're going to do something like that, they're going to have to get the bills started now in order to create whatever that's going to look like. Or I think if the president looks like he's seriously working on it and the ideas make sense, that'll help. But it'd be great if they could put something in place by end of Q2.
Right. And the other thing would be that if the deficit situation, the spending situation is getting better, then you would have room to do policies, spend money to make these other problems less of a problem.
Right.
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 So you can say, okay, I'll use the windfall to spend $500 billion or $1 trillion on these other things because you're no longer, behind and, can't spend. You could spend. So the other thing would be that I think for the natural gas, because of the AI boom, because kind of like this is happening because of the AI boom, then AI boom is building off, new data centers powered with the natural gas. So I think that is a tough solve. But the other big thing would be that if there's a Ukraine-Russia peace deal, then Russia has a lot of the world's natural gas and oil. So if you bring that fully into the world economy, that would be a massive supply boost. I think the oil side is easier. It would, can bring down oil prices more, and they would have potential to relieve on the other side. But that's, even that part of it, a real world thing, seems to be more at risk than the fact that AI could work. It's kind of like peace in Ukraine and Russia is actually lower probability than the fact that AI could change the world.
But the good news is, he's got a team of 3 in Russia and Ukraine right now trying to put this deal together again. So, and one of the things I talk about when I put this together with you this morning is focus. So the president in his first 10 months has been focused on international and tariffs. He's stopped however many wars. He's changed the entire world economy in terms of how we look at trade. He's done all this stuff on an international basis and created a lot of chaos, but seems like a lot of good coming out of it. Now he should be able to switch his focus to those 3 subjects. And if he switches his focus and uses his amazing cabinet, I have some hope that maybe we make at least progress on a couple of these issues before they get completely out of control.
And the other thing is, groceries are actually linked also to the Ukraine-Russia situation because they between both of them, we're making most of the world's fertilizer.
Right.
So we get more fertilizer in, that will bring prices down. It will take, a year to have that happen, but it would massively increase agricultural yields and lower agricultural input costs. It would be something that would affect inflation, how much it costs to eat, but it would take a year. So like peace deal happens, wouldn't be till next year until we start seeing the effects of that. And again, the year after that, this has some lag to it. So with early AI productivity gains that we can see, have a lot of evidence for, we're looking at, in the range of 5% GDP growth. If things get even better, better reasoning agents, we see those better models ship and more productivity happen Q1, middle of next year, then the full 6%, and even beyond that, 6.5% could happen depending on how strong that is.
An interesting thing that I just remembered is that what we're going to see, again, it may not be in 2026, it may take till 2027 to see this, is what happened in China, what happened in India, what happened in Saudi Arabia and the rest of the Arabian Peninsula. They jumped an entire, I would say 20, 30, maybe even 40 years of infrastructure build out that they didn't have to do. This is something that a lot of people have talked about, and it's just an incredible thing. You know, if you don't have to lay down all that electricity, all those electric wires, you don't have to lay down all that phone infrastructure, et cetera, you go directly to smartphones. In 20 years, you get a huge benefit in terms of your productivity and catching up with the world. Well, for the last 40 years, the United States has not been, well, by the way, we have been a huge manufacturing force in the world. You know that, right? Even though we've been reducing, I think we are second largest in terms of total manufacturing after China. But we did reduce, we did get out of the manufacturing business, if you will, compared to where we were. Well, what are we going to be building right now? We're going to be building the most advanced manufacturing facilities, including AI built in from day one, which is going to allow us to also now make the leap over everybody else with brand new factories that will be the most efficient in the world.
One other point I would make, and this would be a more long-term situation, would be that here's the last 12 months of world adding power. So you see that we almost added, just shy for the entire world, China included, almost 800 terawatt hours of power. This is everything: solar, wind, nuclear, the whole thing.
Right.
And they have it broken down below. And then you see that over half of the electricity was China, right? Just over 400 terawatt hours. And then the US is just over 100 terawatt hours. So Elon talked about he wants to add 100 gigawatts of solar power per year soon, 2030-ish, 2032, 2033, or something like that. If you put 100 gigawatts of solar in sun-synchronous orbit, you will generate over 800 terawatt hours of power.
Right.
So this would be adding more than all the world's power every time he does it, right? And then he has plans to go even 10 times beyond that, right? So when he says, I'm going to add 100 gigawatts of power and put it into space and power AI with it, because currently our AI is about like 10% of the US thing, so about like 10 terawatt hours, 10, 15 terawatt hours. It's the US is only adding this 100 level. Actually, the addition is about half of it. So the new AI build is about half of the new electricity, I think it's about 50 terawatt hours. So we're looking at scaling up by this 20 times, right? So this is hugely impactful for keeping it all going, that more power needed for more AI. But then you can put it up there where I'm not making natural gas prices go higher. Your heating bill does not go up when I put it up there, right? And people say, well, China has more power. If you do this, we'll have double the barrel electricity that China's adding, everything that China adds. And they can't even put, again, all of these additions cannot be put directly against AI because we're building power for regular industrial GDP economic purposes, right? So that's just the scale of what that new thing that we're talking about doing. And that would be looking at about like 5,000 to 10,000 SpaceX Starship launches, which, a big number. The Falcon 9 launch is about 170. So we're looking at going, 20 to 4 times more because we'll have fully reusable on those things, right? So to be able to out deliver the entire world's production, natural gas, nuclear, things that have taken decades to do, multi-year projects, all this kind of stuff, grid, all that kind of thing. So this is the energy hack that we're talking about here. And this will mean that if you're doing that 100 gigawatts, and basically it's the US getting use of that power, then the US production goes from 100 terawatts up to nearly 1,000. You're going this nearly 10x jump in US. So how much GDP is that?
A
That we're
lot.
talking
Yeah,
about?
right.
A lot, right? So that's why this first step that we're already seeing the traction on goes insanely crazy once that actual space AI stuff happens. It also means that, people were saying, oh, the curve will flatten out. Physically, we can't add more chips, we can't add more power, which is true. On Earth, we'd have really, really big problems.
Right.
But if now we take off the limits on it, and this is what happens through the 2030s, right? Then the GDP growth, we could be looking at double digits, well beyond double digits, especially if you're in 5 years doubling the electricity in the United States. So,
And Trump, if you're still listening, one of the things you need to do, you need to listen to your own cabinet, and you need to listen to Mr. Musk, who's now your best friend again, and you need to rip up all regulations and go to the states if necessary, override them, override these private utilities. They need to put in these batteries into the grid, the normal grid distribution pattern, because we can double the effective usage of the grid as it exists today without any new wires, without any new productivity, without anything else. All we need to do is put the batteries in, and everybody, this is not like special science or something that takes a lot of math genius. This is something that is clearly could happen, but I think we're going to need to get the private utilities to just roll over, because I don't think they want to do it. What do you think, Brian?
yeah, so there's these huge opportunities. The Industrial Revolution from the 1800s. Before that, we were agrarian, doing farming, and then all the coal, oil, industrial factories, all electricity, all that happened from the late 1800s at scale into the mid 1900s, and that was a 10x, 20x growth in the total power, and it was GDP growth going from 0.5% to 3% regular. So now we can go from 2-3% up to 6, 8, 16%, and the energy growth will be part of that. So this is a true, people talk about fourth industrial revolution, blah blah. This is a true at the what the industrial revolution did. This is another level thing, and we're now all the stuff we went through before just now was the true signs of the beginning of going to 4%, 6%. It's the beginning if we're correct on what's happening here, and then the energy growth is, again, looking for a few decades, will be like difference between pre-industrial, industrial, pre-AI, post-AI. It's just like that huge change of like 10x, 100x over these few decades. It's
And if you were a
and
Tesla stockholder and you're going, Randy, great, I appreciate the video and I really want to know about the general economy, but listen, every piece of what we've talked about this morning impacts Tesla. The reason that we look at Elon Musk as such a genius is because 5 years ago, he knows everything that we just said. He's already thought about this for years. And so we not only have our energy storage capability, we not only have our robots coming, we not only have robotaxis coming, we not only have the second biggest data center in the world right now, and the only one that does real world training. Now we're talking about a chip fab, maybe the biggest chip fab in the United States, and we're talking about the ability to maybe to build a factory to make solar arrays for space. Other than that, he's not participating at all in this revolution, and your stock is going to just go to the moon.
That's right. Yeah, if the economy does that, the Tesla and SpaceX shares will be even higher. It's like, I had an internet boom. If you own Amazon, you were really, really happy, right? So same thing. If we have an AI boom, energy, GDP, productivity boom, then Tesla and SpaceX shareholders will be the happiest of all the people.
Highly rewarded, not to mention XAI as well.
Yeah, right.
All right,
Okay.
Brian, I think we've done it. So
Yeah.
thank you as always for putting that together, and to all of you out there, it's been great talking to you.